Good afternoon. Good afternoon. It's Monday, the 14th of October, and welcome to another edition of Monday Market Picks. My name is Tilan Vikramasinghe. I'm the head of research for Maybank Securities here in Singapore. And thank you so much for joining us on this gloomy and thundery Monday afternoon. The markets are fairly volatile as well and a little bit gloomy. Hong Kong's down, but China is hovering, and the China market is hovering between gains and losses after the Ministry of Finance, China's briefing on Saturday. Was it really a nothing burger, or should we read between the lines? We have Erica Tay, our China economist, joining us to clarify and explain what China is actually doing. And I've actually upgraded the Singapore banks to a positive. Why and what does that mean? Stay tuned and I'll tell you why. What do we do with the REITs now that they've had a very sharp run up in the third quarter? We have Krishna Guha joining us to explain what he's thinking. We got Amirul, the chart guy. He's got two new technical ideas, and I'll take you through that. Eric is shining a spotlight on a construction heavyweight that is worth keeping your eyes on for your investment radar. And finally, we spotlight ASEAN internet stock that has done almost as well as Nvidia. Which stock is that, and what should you do with it? Stay right till the end. So we've got a very busy show. So we're going to jump straight into China and have Erica on the line. So Erica, welcome to the show. Now, there's a lot of confusion on what was achieved during China's Ministry of Finance briefing on Saturday. Did it meet your expectations, and did it meet the Street's expectations? What do you think?
Morning, Tilan. You're right. On Saturday, expectations around the world were very high that China's Minister of Finance will actually announce a dollar amount of new fiscal stimulus to support China's economic growth. So that didn't happen. He did not announce a specific figure of X trillion renminbi for the stimulus, but I think it was a very substantive press conference. He did announce actually something that will help boost GDP growth for the next 3 months. And primarily, the Chinese local governments have actually 2.3 trillion yuan of funds sitting there that were unspent. And the reason the government couldn't spend the funds was because there was a very strict users that they can spend it on. For example, on railways and industrial parks. So local governments have a lot of funding needs, but they didn't need to build such things. So on Saturday, the Ministry of Finance actually announced that it is freeing up this $2.3 trillion to be spent in the coming 3 months on two things. One was buying back land that was not developed from property developers, and secondly, to buy unsold housing inventory and turn those homes into affordable housing. So I think this is very helpful, and I'm sure the local governments will start spending that 2.3 trillion right away.
Okay. So, I mean, I think with this whole thing, some might say that, it lacks a bit of detail. Now, is that a concern? And where's your sort of, how are you kind of thinking through this whole meeting in terms of where the implications are?
So I think that the Minister of Finance could not give a dollar figure for the new stimulus in 2025 because, as he has mentioned repeatedly, the amount and the plan is still undergoing legislative approval. So the National People's Congress has to first approve that spending, and we hope that this happens probably by the end of October. What what the Minister of Finance did was he hinted several times that the amount will be big. So he said that the central government has the scope to increase debt as well as the budget deficit. And he also followed up by saying that there will be a one-off special bond issuance just to help local governments convert their loans into debt. That will be the highest in recent years. So without giving specific figures, I think he went as far as he could, as he was authorized to give helpful hints on what's going to happen next. And that for us is very encouraging.
Right. I think that's encouraging. Definitely. So, I mean, I think I just want to kind of pair this with, China's inflation numbers came out and that was below expectations. But now these are backward-looking numbers as well. How do you take these numbers and how does that kind of, bring in some narrative in terms of what happened on Saturday as well?
Yes, Tilan. So the inflation numbers out of China yesterday actually it goes to show why the government needed to act and take extraordinary actions to prop up the economy. So inflation in September has fallen to 0.4%, and core inflation, which is stripping out food and energy, actually was barely above zero, only at 0.1%. So this was the lowest in 44 months. And besides, in the industrial side, producer price inflation has fallen to minus 2.8% after signs of recovering towards zero throughout the year. So I think these signs point to a severe weakness and severe deflationary pressures in the economy, and it's right for all parties in the Chinese government to act.
Got it. Thanks, Erica. So I think there's definitely some opportunity there. And I think that's why reading between the lines of this press conference is important.
Okay.
Now, while China has some positive trajectory and positive outlook based on what Erica said, I actually looked at how past Chinese stimulus have actually impacted the Singapore banks, given that these are one of the biggest components of the STI. And after that, after crunching some numbers, I've actually upgraded the Singapore banks to a positive outlook, and I've actually upgraded OCBC and UOB to buys from hold recommendations, and we're keeping a buy recommendation on DBS. Now, one of the biggest drivers for this is a normalizing or even growing China following the barrage of stimulus measures that has been announced. When we look at past stimulus, we see this having a very positive impact on the North Asian loan growth for the Singapore banks. Now, if you look at North Asian loan growth back in 2010, it expanded 34% and another 60% in 2011 from a negative reading in 2009 when China actually introduced the stimulus measures. Similarly, in 2015, loans went from a negative to a positive 13% by 2017. So while the details this time in terms of stimulus is limited, there is substantial intent by the Chinese government, as what Erica said. And this can be another lever for growth for the Singapore banks, given that between 16% and 29% of their loans are in China. And a lot of these loans, a lot of these loans are wholesale, and a large chunk of that is to SOEs in China. So if stimulus happens in China, the SOEs will benefit, and then that will have a benefit to the Singapore banks. We've actually raised our 2025 to 26 loan growth assumptions by about 2 to 3 percentage points, which is ultra conservative given the high double-digit growth rates that we saw in past stimulus. And we are not even counting non-interest income yet, but we do expect to see a bump there too. When we drill down to geographic profit before tax, we do see sizable recoveries after past stimulus. So we think that there's quite a few earnings upgrade opportunities for Singapore banks going into the next 2 to 3 years. Now, apart from that lever, we see a confluence of other drivers also coming together to support earnings, including the Johor Singapore SEZ. We've talked a lot about that in past shows. Plus falling rates driving regional loan growth demand, supply chain relocations, and expected fiscal stimulus, especially in Thailand and Indonesia. And this will all benefit the Singapore banks because they have a regional presence and they have an integrated presence. So it's a lot more easier for them to move when these sorts of changes happen in domestic economies. Now, also touching on third quarter results, which will be out on the 7th and 8th of November, we do expect some earnings momentum to come off from a very high base and also some falling NIMs. We think there will be more evidence that NIMs falling is better controlled, given some of the hedging that has been done in the past few quarters. While loan growth guidance, at least for this year, will still remain fairly conservative. On the other hand, we're expecting a strong improvement in fee income, especially in wealth management. The market conditions have been very supportive in the third quarter, and these banks have built up massive AUM over the last few years, and they have been encouraging clients to move money away from FDs more and more towards CASA. So we think some of that will move towards wealth management products and drive earnings there. So overall, next 2-3 years, earnings momentum will be slower than the past 3 years, but that's based on current economic growth forecast, which doesn't really take into account a China recovery. But either way, dividends growth should be actually growing faster in the next 3 years than in the past 3 years. All three banks offer about 6% above, higher than 6% yield for next year, which is very, very attractive. And that's actually based on the fact that a lot of them have a lot of excess capital, which they will look to pay down. Now, all of this has led to us bringing up target prices. DBS, we've raised the target price to $44.06. OCBC goes up to $17.10, and UOB to $35.62, which makes them all buys under our classification system. And even then, even at these target prices, we don't think valuations are particularly stretched. Most of them will be trading at historical means. So do have a look at our very detailed note today. Now, with that, I want to turn to the REITs, which have had a very solid performance in third quarter. And Krishna joins us for that. Krishna, welcome to the show. And Krishna, you have actually been on the road meeting a lot of institutional investors recently, talking about REIT. So let's start there. What's the mood on the street right now?
I guess the best way to summarize for this sector is, love it or hate it, but you just can't ignore it. The institutional investors that we met, they are positioned on the select large caps. And after the third quarter rally, year to date, they are flat. So on a total return basis, they are still up. But they are considering whether to chase the sector here or not. The discussions basically centered around what's next for the sector and what are the growth drivers, be it the lower financing cost, be it capital recycling to divest some of the underperforming assets and position themselves into the better assets for the next 2 to 3 years, or other top line drivers. So those were the main discussions, and it seems to me that most investors are unwilling to chase the sector at this point in time after the strong third quarter rally.
Right. I think that's an important point to kind of take home. Now, in the short term, it's run up, probably not the best time to chase it. But when you think about a slightly more longer term, medium term sort of time frame, how are you stacking your sector preference and why?
Yeah, so we have preferred the industrial and the retail sector for some time. We have included the hospitality sector as well, and this is on the back of the visitor arrivals starting to scale new highs, and we are entering into a seasonally stronger second half as well. But that said, if you look at the year-to-date numbers, we are still about mid-teens percentage point lower than what it was in the pre-pandemic. So there is room to grow. Our concern has been that probably the hotel guys will have to lower their room rates to boost up occupancy. But so far they are able to hold on to that and still able to inch up the occupancy. So not too bad setting on that front as well. So we are having industrial, retail, and hospitality as our preferred subsector in a slightly longer term view of the sector.
Right. And in terms of, so near term, you think it's going to tread water? Is that a reasonable sort of assumption to make for the REITs? And what are your top picks when you look at it from a fundamental point of view?
Yeah, I think near term, I think there will be a consolidation in the sector because we are coming up from about 15 to 20% share price return in the third quarter. And then the yield has backed up significantly, about 40 basis points. And some of the data points on growth and inflation suggests the narrative of that soft landing. So, you know, the interest rate cuts may have to the expectation on the interest rate cuts, both on the speed and the quantum, may dial down a bit bit from what it was at the end of the third quarter. So I think it will be more of a phase of consolidation and looking at the various data points and then, you know, position for the next year as to how it kind of pans out. In terms of our picks, we have among the large caps, CICT, Mint, MLT, and Capital and Ascendus. So these are basically mapped to our preference for industrial and retail. And then on the small and mid cap, we have the three hospitality names, Capital and Ascot, CDL Hospitality Trust, and Far East Hospitality Trust, which should benefit from the hospitality strength in the second half. As well as we have Lendlease, Global Commercial REIT, and OUE REIT, which are high-yielding names. So those will round up the preferred picks in the sector.
Great, thanks, Krishna. So this actually, for our viewers, this actually might be a good opportunity for a tactical switch from some of the REITs, take some money off some of the REITs, and tactically look at the banks, given the fresh sort of tailwinds that the banks might have going into the next few months. So do have a look at that. Amirul, our chart guy, can't join us today, but he's got two trading buys. The first is Leong Asia. He says that the bulls may continue the uptrend following the recent moves of that stock. And he also has a trading buy on Nam Cheong Limited as well. It actually broke out from a triangle pattern last Friday. And the breakout actually could signal a more bullish continuation going forward as well. So do look at those charts in our newsletter today. Now, let me bring Eric onto the show. He's just published a Discovery Plus note on Tiong Woon Corporation. For those who are not familiar with Discovery Plus, it's a very special series that Maybank Securities does to highlight stocks that are worth keeping on your investment radar. They don't carry a rating or a buy or sell or a target price, but we think they're interesting enough to highlight to our investors. So Eric, let's start with, what does Tiong Woon do?
Hi, Tilan. Thanks for having me. Okay, for those who are not too familiar with the company, Tiong Woon is currently the 15th largest crane owning company worldwide. It's headquartered in Singapore and has been listed on the SGX main board since 1999. Tiong Woon is now one of the leading one-stop integrated heavy lift specialist and service provider with quite a meaningful regional presence in 13 other countries. Singapore is currently the top revenue contributor, accounting for about 75% of the group revenue, followed by India with a 9% contributions.
Got it. So Eric, what are some of the tailwinds that the company is enjoying and could continue to enjoy?
All right. So Tiong Woon is currently benefiting from the booming O&G, petrochemical, infrastructure, and construction sector in the region. We recently reported FY24 net profit of 18 million. which was up 16% year-on-year on revenue growth of 5% to 143 million. In fact, this marks the group 7th straight year of earnings growth since FY18. And given its strong operating cash flow, Tiong Woon has also raised its FY24 dividends per share by 50% to 1.5 cents. This translates to a dividend payout ratio of only 19%, and we think that this could allow room for them to potentially increase their dividend payout going forward. And looking ahead, management is maintaining a positive business outlook as demand for its equipment is likely to stay buoyant in Singapore as well as key markets such as India, Saudi Arabia, and Thailand. And valuation-wise, based on Bloomberg consensus estimates, valuation does not seem demanding. Is trading at just 6 times PE, 0.4 times price to book, and about 3.8% forward yield.
Okay, so pretty reasonably valued. So the catalysts are more dividends and better earnings potentially coming through over the next couple of quarters.
Yeah.
Okay, thanks, Eric. Now, finally, do you know that C Limited is up 145% year to date, which was almost on par with NVIDIA until a couple of weeks ago when NVIDIA kind of accelerated a little bit forward. Now, Hussaini has bumped up his target price to $110, which is about 15% higher than what he had before, and he's keeping his buy call. He thinks that regional e-commerce competition is benign, and this is good for better monetization for C. Digital ads can play a bigger role for C right now. They only make up about 1 to 2% of their GMV, when for global players it's around 4%. Plus take rates also should increase to about 3%, which is still below 20, which is about 20% below what the global levels are. So basically, overall EBITDA for this company could actually accelerate going forward. He's actually increased his profitability forecast by about 2 to 9%, and that's driving some of his upgrades. So do have a look at C. We think there is a lot more room for this stock to run. Now we're very tight on time, so let's have a quick look at upcoming events and announcements. We've got results season starting with most of the REITs starting to report. We've got Parkway Life out on the 16th, Keppel DC 18th, a lot of investors following this name. OUE REIT on the 23rd of this month, and the Nodex numbers out on the 17th. In terms of events, we've got the Citrium event, which is happening on the 16th. So if you haven't registered for that, it's still not too late. Please do so today. With that, unfortunately, we are out of time. Thank you, as always, for your support and for joining us. Have a profitable trading week, and see you next week.